Good morning, everyone, and welcome to our webinar this morning. We've got Jonck, who's going to do the second part of the finance, the webinar series. So we're looking forward to that. Just a quick note to everyone, please just put your mic on mute and leave it on mute for the session. Hans will open the floor for questions after the presentation. So please just take note of that. Then without any further ado, Hans, thanks so much for your time. We look forward to this new webinar in terms of finance.
Great, thank you, Francois, and welcome to my fellow PJ professionals and the peers in the industry. It's my pleasure to give you the second webinar today on finance, and it'll probably be my last one for the year. So my boring voice won't bore you anymore for the rest of the year. I hope that the majority of the participants today attended the first webinar, because it's kind of a follow-on. But for those that didn't attend, I'll try and simplify it as much as possible. So thank you for your time again, and Francois, maybe press that record button. So
yes, it's recording. Thanks, Hans.
Thank you. Great. All right. So today we're going to talk about the basic finance for a small business, but it is applicable. This is the basic fundamentals that's applicable in the bigger business as well. I'm trying to keep it as simplified as possible for our industry and knowing the organizations that PJ professionals are involved in. Again, a little bit about myself. For those that hasn't been on the call, I've been blessed to be part of this industry for 16 years. I actually got my 10-year certificate on Monday at our regional AGM. Thank you to the PJ for that. And our business, my own club, is about golf club management business. So we're helping clubs with strategic planning, management, and the majority is financial work. So that's the pedigree of who we are as my own club. Just to recap on webinar 1, we went through what is financial accounting. We spoke about the definitions, the certain terminologies, how the accounting cycle functions. And then we went into what is the financial statements, being the income statement, the profit and loss statement, balance sheets, cash flow, and then age analysis. You can just ask those participants that came in just to mute yourself. Otherwise, I'll be sending you exams to write after this webinar. So today we're talking about budgets, the importance of a budget, creating budgets, how do you manage budgets during your financial year, your forecasting and adjusting of the budgets, what financing, if you're starting a new business or you in business, what financing options you do have available. We talk about tax, understanding what income tax is about, VAT, pay as you earn, and then finally pricing strategies. So I've created some content for what would be applicable to golf coaches, to retailers. So I've tried to keep it specific to our industry. So today, by the end of the webinar, we should be able to know how to obtain practical budget skills. We can also see that we gain comprehensive knowledge of financing options, the advantages and the disadvantages thereof. And then finally, we can clarify what is the tax obligations that we do have as employers, and also what would be the effective pricing strategies that's applicable to our industry. Let's talk about the budgeting basics. And this image, again, I've pulled from the on-course portal. So for those of you that like to go and do further studies, once again, I didn't put template examples on there because I'd really like you to go to the on-course record and complete those short courses. It is really beneficial. There's some great content in there if you'd like to take this further. So budgeting basics is the cornerstone of financial management, which is budgeting. So a well-planned budget is crucial for any small or big business. It helps you track what is your income, what expenses can you expect, ensuring your business stays on track. And then also proper budgeting can mean that the difference between having actually a thriving business or having just a merely surviving. it scares me to say I've seen golf clubs operating without proper budgets, or any budgets for that matter, and they just purely managing the business on what's available in the bank. So quite risky to perceive it in that way. When we look at creating a budget, we're looking at five different sectors. We're going to spoke about what is the incremental budgeting, the kind of methods, the steps of the budgeting, understanding what fixed and variable costs are and how do you budget for that, understanding the difference between what is revenue and what is income, and also some keynotes that's slightly more advanced. So let's jump off in terms of there's a couple more methods, but the two main methods we're looking at, if you're looking at a budget, is number one is incremental budgeting. So incremental budgeting is actually using the previous period. So let's say you do have previous sales history or trading reference that you can use as a base, and you can make adjustments on that for the new period. If it's a brand new business, you've got no other choice to go on to the next step. But the adjustments are typically incremental increases or decreases based on expected changes in either your revenue or expenses. So some of the advantages is certainly simplicity. It's a straightforward and easy implement strategy, since it builds on what you have as an existing budget or the profit and loss of the previous year, or the income statement. And then we also look at the advantage of stability. It allows for gradual changes to be made, making it easier to predict your future financial needs. The disadvantages, number one, is inefficiency. It may perpetuate that your past inefficiencies, since it assumes that the previous budget is largely correct. We get thrown with utility bills, just getting more and more water. We're paying 35 to 40% more in the industry right now for just consumption of water at golf clubs, or what I picked up. So those kind of things just can't work on last year's budget. So if you want to use the incremental budget, I would suggest you use your income statement of the previous year. The big disadvantage is the lack of innovation. You just keep on doing what you've done, so it doesn't encourage a thorough review of the expenses, and can quite stifle new initiatives. Number two is the zero-based budgeting, the ZBB. This is merely for, obviously, when you start a new business, but also when you're running a business. Zero-based budgeting is a method that's used at starting from scratch each period. You determine, what is my lesson income going to be? What is my retail sales going to be? Am I budgeting for apparel sales on its own, or I just say pro shop sales? Or am I budgeting for apparel, accessories, gloves, balls, and so forth, in order for you to set your own financial key performance indicators? But every expense must be justified and approved, rather than just adjusted from the previous period. Advantages, again, of this is you have proper efficiency. It encourages a thorough review of all your expenses, revenue, which can eliminate other wasteful spending or over budgeting on revenue lines. It gives you some flexibility as well, so it allows for more dynamic allocation of resources based on the current needs and your priorities. The disadvantages of using the zero-based budgeting is that it's quite complex. You're spending more time doing more market analysis, more research, and sometimes can be complex to implement. So and then the other one is that it requires resource incentives. We always encourage, excuse me, in the golf club space, if you have a proper food and beverage manager and you have the golf director, is for them to present the budgets for the next year and motivate before it gets consolidated into the main budget set. These are the guys that's on the ground daily. They know what they need in order to perform at the best levels. So it is quite resource incentives. It's more effort to create a new budget from zero. But again, to summarize the methods, but choosing between the incremental or the zero-based budgeting depends on what your specific business needs or goals and resources might be. If you're a one-man band, been trading for a couple of years, you can use an incremental budget. If you don't foresee any significant changes in the following year, there's nothing wrong with an incremental budget. Zero-based approach is preferable from my side, because you spend time, you set new goals and objectives for the following year. In the golfing space and the work that we do, when we do budgets for clubs, we use we certainly use a combination between incremental and zero-based. Incremental, if I talk about just the green fee line, if we do member green fees, you know the spikes and fluctuations you're having because of season, as an example, and you're saying, I'm going to increase my price of 6% this year on the green fee price, but I want to allow for 2% growth, more rounds to be played, then we use an 8% increase overall. But the rest of the lines, when we look at spending on diesel, irrigation, what projects might be, then we use a zero-based approach for that. So those are your two kind of methods. Right, the steps of budgeting. And I'm not going to go through this one by one because I've got the slides prepared. Number one is gathering your financial information. So define what your financial goals will be. You can have historical trading figures. If you're running a pro shop, as an example, you know exactly what you're doing, where you fall short, where you think you can push more next year, what gives you the most margins. If that's a specific objective of you, it can be done. It can be monthly goals, it could be quarterly goals, any long term. So it's, again, if I break it down, you can do it by either increasing your revenue or reducing costs in specific areas, or you can save for future investments and say, this year I need to make proper money in order to spend it the following year on a certain project, in order to make sure that I sustain my business for years to come, or if you're just expanding the business. Step 2 is determine your income and revenue. Now, let's set the tone of what revenue is. Revenue is the sales that you generate from either delivering a service or from selling a product. If I'm selling a sleeve of 80 333s, that's a revenue item. Then when you look at your income items, those are the things that you're making outside of your main purpose of deriving revenue. This could be, if you win a pro, that kind of money that you want to bring into your books. Those are the kind of things we're looking at. Other income is anything outside of deriving sales, either rendering a service or selling a product. So when you look at understanding where your income and your revenue comes from, is what is your sales revenue. You can use reports. If you're golf directors on this call, you're looking at spend per heads. If you're running at 200 Rand spend per head on your green fee and you say, I need to push it up to 220, I'm doing 50,000 rounds a year, that means I'm adding R1 million to my revenue line. If you're doing 50,000 rounds and people coming through a pro shop and you're doing 50 Rand spend per head and you again raise it by 10 Rand, you're making R500,000 Rand more revenue. So those are the kind of things that you can think about. And again, this comes back to using a zero-based budgeting. Are you going to incorporate any new facilities? I mean, as we spoke previously on what paddle has done to the industry. If you're going to build paddle, make sure then you use the zero-based budget in order to understand what is the potential revenues I'm going to make out of having a new facility. You have a driving range and you invest in launch monitoring equipment. How are you going to derive revenue out of utilizing that piece of equipment? Any kind of service income, you have investment income. If you have R1 million in the bank at 10%, how do you use that interest into your income statement? Those are the kind of investment incomes we're looking at. And then any other sources of income is, do you receive donations? Do you get sponsorship? And you're bringing that in terms of your business. So this is setting the top line in terms of what I'm going to generate in revenue in order to make money to cover my next, what is my expenses. So fixed costs are those things that's not changing on a monthly basis. They do not change because of the level of productions or sales, rent, cost of sales, salaries, insurance. If you run a pro shop and you're doing 300,000 Rand this month and 500,000 Rand next month, yes, the cost of sales changes, but it's the percentage that hopefully stays the same or increases. So we're looking at your fixed expenses of what is cost of sales, rent, insurance. Do you have any loans that you need to repay? Salaries, you know what you're paying your staff on a monthly basis. Step number 4 is variable costs. So these are the costs that fluctuates on the level of what business activity you have, your water and lights. If you have any marketing expenses you're spending on, commissions, you're paying your shop staff commissions on their sales, you're paying for your programs going to there, you're paying for your travel, and so forth. These are the variable costs and what you list in terms of your budgets. Now that you have your revenue, you have your fixed expenses, your variable expenses, it brings us into our last step of the budget, is the bottom line. Are we making a profit or are we making a loss? And have I achieved what I've set out as my financial goals and objectives? Bottom line is calculated by my income minus my expenses. And then finally, have you achieved your objectives set out in step 1? That's in terms of creating the budget. Now you've accepted a great budget and you're happy, you're inspired, you're going to have a fantastic year. And then the rubber hits the tar after the first quarter. And now, if you see my spelling mistake there, I should have put an A there. Forgive me for that. Now, after your first quarter, you need to review and you need to see, have I achieved what I set out to do? What has happened? Why didn't I achieve that? So when we look at this, once your budget is set, you need to monitor it regularly. You can choose whether I'm doing it monthly, quarterly. I won't suggest review it after the first year, because then you don't have time to implement new strategies. Compare your actual expenses against your budget amounts. Very important. If you see significant deviations, investigate what the causes would be. Did you spend more on marketing that's planned? If you did you generate the revenue, more revenue that's expected? Did your sales fall short because of certain expectations? And then based on your findings, it's important then to do the necessary adjustments. It might be that you adjust your budget accordingly, or it might be that you change your strategy and approach in order to achieve those budget goals. So it is an imperative process that helps you stay flexible and responsive within your own business environment. So 4 key notes when you monitor and adjust is the importance of regular monitoring is that consistency is key. So if you regularly monitor your budget, and again, if you do it quarterly, keep on doing it quarterly. If you do it monthly, keep on doing it monthly. I don't see any reason why it can't be done on a monthly basis. So regularly monitoring your budget ensures that you're on track to meet your financial goals, and that can quickly identify any discrepancies between your projected and your actual figures. And then early detection of issues. The early detection of issues is, it helps you. If I have a bad first quarter in my financial year and you set out to do 1.5 million profit, but you made 400,000 Rand loss in your first quarter, you've got a lot of catching up to do. So it's your ongoing monitoring helps the early detection of your financial problems, and then it allows you to address it in a timely manner. All right, then I see here there's some background noise. Francho, if you can get the name, I'll send the exam. If you can just have that person just mute himself. Then we're looking at the techniques for monitoring. Number 1, monthly reviews. Certainly something we suggest is that you conduct your monthly reviews between your actual versus your budget. Then the use of a financial software. Now again, small businesses can really use Excel. Make sure you capture the data accordingly. But there's so many cheap options out there that can really help you spitting out the numbers at the end of the day. What was my actuals versus my budget? So the utilizing of an accounting software to automate the tracking process really assists the process. Then we talk about key performance indicators. Again, if you establish KPIs that are relevant to your business, I'm going to do 100 lessons this month, or I'm going to do 50 lessons at this rate. Did you achieve that KPI? So that can be, or it can be a shop. Am I achieving my profit margins? If I'm set to do 30% gross profit margins in a retail store, have I achieved my profit margins? What is my cost ratios? How's my cash flow levels looking like? Those are key performance indicators. A big thing for retailers is stock turn. Am I sitting with a lot of dead stock that's been paid for, and all of a sudden I need to discount? Am I turning my stock frequently enough in order to meet my key performance indicators? Right, then we're looking in analyzing variances. So now you've got this document, you see I've done great in revenue, but I've done even better on spending more money than what I was supposed to do. Is to perform and understand the difference between what was your budgeted and actual figures. Did City of Joburg increase their rates in electricity and water? Certainly, I need to adjust my budget for the next year, or I need to implement plans in order to reduce my water consumption or reduce my electricity consumption. So sometimes you can make favorable decisions, which is better than expected, or you're going to need to make unfavorable, that's worse than expected, and sometimes it ends up laying staff, whatever the case might be. And then finding the root cause of the analysis. And again, as I used the City of Joburg example, paying more for utilities, it is what it is. The root cause, they've increased the price. It's not something we can change. I need to adjust my prices going forward in order to pay for that cost, or what else I'm going to do to alleviate these kind of issues. Then we go into making the adjustments. Is the final step on the monitor and adjust. So adjusting the revenue projections. Number one is if your revenue is consistently below your projections. Let's say you as a coach say, I'm going to do 100 lessons at 500 Rand a lesson this month. I'm going to generate 500,000 Rand of lessons. I'm only achieving 250,000. You've overstated. So then you need to see what other sales strategies you can implement in order to achieve that, or adjust your budget accordingly, which means, well, obviously a negative result. If you just look at revenue, what are you going to do then on your expenses side in order to make up your, or to achieve your financial objectives? Managing expenses. Now, there's a saying that you can't save yourself to death. I've seen it many times where sadly there's just no money. So we're not going to do repairs and maintenance on clubhouses. You fall so far behind that it becomes at an irreparable state. You need to go and borrow money just to maintain a clubhouse. Not necessarily going to generate more revenue to you, but it's managing those kind of expenses. So look for areas where it can be reduced, of course, without compromising your quality or your service, the quality of your service or the quality and product that you deliver. Never substitute your quality for saving costs. So that might be you renegotiate supply contracts or finding more cost-effective solutions. And then lastly is reallocating the funds. So if you've made the adjustments, if certain areas of your budget are underutilized, then you can consider reallocating those funds to areas that additional resources or show higher returns on investments. So that's what I've got in terms of monitor and adjust. Our final 2 slides on budgets is more advanced keynote. So if you look at where I didn't cover is your forecasting of income and expenses. So if you do have historical data, market trends, quite important. See what the market is doing. In South Africa, we lead in many aspects, but we do follow, if we look at our industry, what is out there. So look what the industry is doing, look what they're charging, estimate your future income and expenses accordingly, and then also be realistic of your scenarios to best case and worst case. Two is allocate the funds. We've addressed that slightly, but allocating the funds accordingly is quite important to know that what categories based on your forecast we're going to do. If I'm not doing well in my lesson sales, or I haven't spent on marketing this year, how I'm going to allocate those funds in order to perceive the greater good in my business. Monitor cash flow. So you might have a fantastic year, you're shooting the lights out, your actuals looking much better than your budget, but you don't have money in the bank because your debtors aren't paying you, you're not paying your creditors. So if we can just have that background noise, please on mute for those that came in. So very important is to keep on monitoring that cash flow. Plan for contingencies, plan for quick price hikes in utilities, plan for reconstruction in your, let's say your driving range is going through a construction phase. That's a contingency you need to plan for that year. Or all of a sudden your irrigation line break of where you need to irrigate for your driving range. What is your contingency going to be? Now all of a sudden I need to spend 5,000 Rand on heating mats in order still to keep rendering a service. To plan for those things, review and adjust regularly, communicate the budget to your stakeholders internally, and then use budgeting tools. Some of your budgeting tools can be Excel, Google Sheets. If you have Xero or QuickBooks or Pastel or whatever, those are your accounting tools and softwares that you can utilize. And then finally is involve key team members. And here I'm talking more to the bigger golf clubs. And as I've opened up, if I'm managing a golf club, I'll never do a budget just with me and the financial manager. Yes, we're sitting with all the information. I will go and say, Mr. Food and Beverage Manager, here's your past sales figures of the year. Here's your expenses. Come and present a zero-based budget to me based on the information that's in front of you. And it gives firstly them the authority and the responsibility in order to commit what needs to be achieved the next year. It will be proposed to myself. We'll go through the numbers, financial managers, we conclude final budget, then we take it to the board, which makes the communication of the budget point relevant. Last slide on budgeting. The common mistakes that we do is that we overestimate the revenue. We underestimating expenses. We're certainly not setting aside funds for unexpected costs. We're ignoring our cash flow management. And then the one that I love, just add 6% to everything, and the same as last year. And then the same stuff last year doesn't happen. And all of a sudden you don't have control of actually what is happening within your business. Great. That concludes the budgeting. I hope there was some fruitful points that you can take for yourself. We're moving to now the realm of financing options. This is applicable to a startup business, or if you're running a current business and you need to do some upgrades or new projects. Where is the finance going to come from? So there's multiple points that we can look at. I've prepared four for today that's relevant to us. And I like the word bootstrapping. It's really where you take the bull by the horns and do the self-funding, you strap your boots and say, okay, I'm going to utilize my personal savings. My personal savings is money that I've made personally, and I've put the money aside. I'm investing that back into the business. Retained earnings. Retained earnings is a term that's used at the end of a financial year. If I made 500,000 Rand profit last year, I can say I'm going to draw 100,000 Rand for myself, and 400,000 Rand I'm putting back into the business in order to grow my balance sheet and my funds for the next year to do certain projects or whatever the case might be. That term is called retained earnings. I hate to say this, but you've got credit cards available. If it's a small little investment needs to be made, credit cards, or finally you can have sale of assets. What are you selling within your business in order to generate cash to do new stuff? Advantages of that is that you don't incur any debt, apart slightly from credit cards. You maintain full control over your business, and you can help develop a financial discipline. Disadvantages that you have limited capital available, depending on your savings. You do have personal financial risk, and then your growth may be slower due to the limited resources that you have. Excuse me. The next one we're looking at is bank loans. So small business can apply for term loans, as we call it, the other way, lines of credit. So loans are a popular financing option. There's various types of loans available, each suited to your different needs. Everything changes with interest rate. The more protected, the lesser interest you'll pay. The more aggressive, obviously, the more interest you'll pay. I've seen loans of revolving loans at 21% interest. I mean, that's quite significant numbers we're looking at. So when you look at the advantages of a bank loan, is that you've got access to a lump sum. If I need 500,000 or R1,000,000 for a project, I can have access to that. The advantage is you have a fixed repayment term. So let's say I've got a loan of R1,000,000. I'm going to pay 15,000 Rand a month back on this. You know exactly what's your repayment term is going to be. And you're starting to create a relationship with a financial institution, building up your credit ratings. Next time when you're looking for something, it's easier to gain the access and the funds on that. Then the disadvantages is that there's strict qualification requirements. If I'm a startup business right now, I don't have any trade references. I don't have any security to give them. You might not qualify for a bank loan. The interest rates can be high, and the admin fees as well. Then also you stand the risk of collateral requirement. Now, collateral is when you own the land or the property, and you're signing that off over security to your financial institution, meaning that if you can't make the repayments, they can lay claim on your asset, land, property, and so forth. Number 3 is investors. There's 2 types of investors we're looking at, is an angel investor and a venture capitalist. Now, angel investor and venture capitalists can provide significant funding in exchange for equity in your business. You own the business 100%. When you look at investors, you're going to have to give some of that equity away, depending on what value is required. But angel investors are, let's say, typically your high net worth individuals who invest in the early stages of the company. They believe in your business plan. They can see that they're going to need some help to get off the ground. And then where venture capitalists are the professional investment firms that fund high growth potential businesses. So you've been trading well, they can see your significant growth. These are the venture capitalists that say, I'm going to put money into your business because my return is going to be so much better. So that's more professionally based. The advantages of that is you can have significant funding for rapid growth, especially if you have an investor that understands the industry that you're in, access to the expertise and networking opportunities. If I ever had to sell our business or not sell, get investors, certainly will be worth our while to look at people that's already in this industry or the same kind of things that can help grow this business from where we are today into a much bigger business. And then you've got no repayment required. I'm looking for 2 million Rand. I get an investor, pays the 2 million, I stand off my equity. There's no repayment that needs to be made. Disadvantages, number 1, you lose control and ownership of what you had in the business. You have a high level of scrutiny and expectations. Now you're sharing every single decision with them, every single motivation. They've got expectations, you've got expectations, and that's a process that everyone needs to manage at that time. And then you have limited availability for certain industries or stages. If you're a very sophisticated industry, it will be tough getting investors that doesn't understand exactly what you do or how you do it. Then the last one I have in terms of prepared is crowdfunding. Now, crowdfunding is raised funds from a large number of individuals. So when you look at the advantages of crowdfunding, now this means it's a couple of people standing together, raise the money, say, there we go, good-hearted people, and say, okay, we're going to support this person in opening up a new pro shop. The advantage is that you got access to a broad pool of investors. You've got marketing and validation of the business idea. They believe in it. You feel confident, they support it, and you've got no equity that you dilute. So meaning it's still your business. The disadvantage is it can be time consuming to run a campaign. If you want to run back a buddy to start a new pro shop, it will take time in order to raise the funds to do what's required. You will be paying for platform fees and regulations. And then finally, you've got a potential lack of ongoing support from your backers. So those are the kind of funding that you can have available in this industry. Obviously, there's many more, and I've prepared slightly from it. If you're running business, you can look at overdraft. Now, overdraft is money if you have, the best way of saying it, for allow your bank balance to go into a minus. You've got immediate funds available to it. Disadvantage, you're paying a higher interest rate. You can flex my repayments. Am I paying $5,000 back this month or 20,000 Rand next month? You can flex those payments coming back, but again, it's done at a high interest rate. Then we're looking at supplier trade credit. It's more probably relevant to the retailers. If you pay, I don't want to mention supply names, but your golf ball supplier, if you only have a 14-day account with them, try and negotiate 30 days, or some cases you can maybe get 60 days. It allows you to have the stock to sell in order to build up funds. In very rare cases, still in our industry, grants, but this is small businesses can actually explore grants and contests offered by the government agencies, the non-profit organizations, accelerators to secure funding for projects and initiatives. So best example I can think of right now, if you're running an academy and you want to support the local community through running a initiative that's going to sustain good sport, healthy hearts, those kind of things, you can actually try and get grants from your local municipalities or governments. Great, that's funding. So I'm trying to pace myself. I still have two subjects to cover, so I hope you guys are still awake and with me. So understanding the different tax types and the tax obligations that you have as an employer. I've just highlighted the three today of income tax, pay-as-you-earn, and VAT. Now, income tax and pay-as-you-earn goes hand in hand. But as a small business owner, you need to be aware of what various taxes are applicable to you. So federal income tax is a given. We can't shy away from that. It's a criminal offense. So the income tax is a given. So that's an income tax, which I'll explain that we as income earners are taxed on. We have state and local taxes, which can vary quite significantly. We've got sales tax, payroll, but the most important when it comes to tax obligations is your record keeping, is maintaining accurate financial records. It's both essential for managing your business and complying with tax laws. So keep all your receipts, your invoices, financial statements, and those things organized. Ultimately, use an accredited accounting software. All right, let's look at income tax. And I want to explain this not to you as a business owner, is how it works in South Africa and the rest of the world. So income tax is governed by or imposed by the government on income that's generated for individuals and within their jurisdiction. So in South Africa, our income tax is collected by SARS, the South African Revenue Services, and is a key source of revenue for the government. So in terms of your employer duties, before I go into the employer duties, just to give you some food for thought. So I actually saw quite a nice meme the other day to say, I'm really battling with maths until I see an issue on my payslip. Then all of a sudden, we mathematicians. So income tax is determined, and I'll get into pay as you earn. So I've got my gross earnings. I'm earning 10,000 Rand a month, and I'm getting taxed on my 10,000 Rand as income tax. So my net pay, as an example, is 8,000 Rand. That 2,000 Rand is then called as my income tax. So in South Africa, we've got different tax brackets. If you just some instance, it varies from 0% right up to 45%. So if you on an annual basis earn up to 88,000 Rand per year, you are taxed zero. If you're earning between 300,000 and 415, as an example, you'll be at 31. If you earn over 1.5 million a year, sorry, for you're at the highest bracket of 45%. But when we look at your duties as an employer, you need to make sure that you are registered with SARS for pay-as-you-earn purposes. So this is necessary in order to deduct and pay over employee income tax on their behalf. So that's why you, as an income earner, gets what you see in your bank account is your net pay. The company is holding back the pay-as-you-earn, which is an obligation that they then need to pay over to the receiver of revenue. And then deducting and paying over pay-as-you-earn. So as an employer, every month when you do your salary run, you get a schedule. If you use, again, an accredited software, it's self-calculating your pay-as-you-earn obligation, and that generally needs to be paid. Let's say your salary run pay-as-you-earn got you to 50,000 Rand. You pay your staff on the 25th. You still have up till the 7th of the following month to pay the 50,000 Rand over to SARS. That's the obligation. The moment you start falling behind that, you start paying penalties on that. So good governance, if you have the money in the bank account available, then rather settle SARS as quickly as possible to avoid those penalties. You need to issue IRP5 certificates. Hopefully you all know what I'm talking about. So at the end of each tax year, especially now we're in the tax window, you must issue the IRP5 certificate to your employees. The certificate provides a summary of all the income that you've earned, the taxes deducted, and other relevant information for the tax year, which then gives you an IRP5 document that's self-calculated on the SARS e-filing in order to justify exactly those earnings and the deductions. Then you need to submit and reconcile the EMP 501s. So you as an employer are required to reconcile the pay-as-you-earn deducted from your employees, salaries amounts paid over to SARS on a biannual basis. So every 6 months, you need to submit EMP 501 documents. Providing tax certificates, your compliance with your tax laws. It is essential to comply with all the relevant tax laws, pay-as-you-earn, VAT, and so forth. And then again, keeping records of your transactions. So now that I've explained income tax, pay-as-you-earn would be relatively easy. So pay-as-you-earn is, as an employer, is the income tax that you've held back from your salaries that you've paid in order to settle SARS. So employers are responsible for deducting income tax from their employees' salaries. The amount of tax deducted is calculated based on the employee's total earnings and your tax bracket and any applicable tax deductions or rebates that might be given. As an employee, you've got a couple of responsibilities. You must, obviously, as I said, register for pay-as-you-earn with SARS and obtaining a tax reference number. You must calculate the correct amount of income tax. Submitting monthly pay-as-you-earn to SARS. So once you've done your salary run, you log on to e-filing, you load the salary run on there. You then have an obligation to pay that calculated amount. And as I said before, the end or the 7th of the following month. And then you pay over the amount to SARS before the deadline. So how does it look like on the employee's pay slip? So if you receive your pay slip, you'll have your gross earnings, your 10,000 Rand, you'll have your income tax deducted of 2,000 Rand, You'll have your UIF deducted, which is generally a % of your gross earnings. You have your skills development levy, if applicable, that's been made by the employer, which finally gives you your net earnings at the end of your payslip, and that's the money that you'll receive in your bank account. And then finally is your compliance and penalties. Employers must comply with all the pay-as-you-earn regulations and deadlines, and avoid penalties, and failure to pay over pay-as-you-earn on SARS can result in penalties being imposed, and in some instances, criminal offences. And the last thing on tax obligations is VAT, as value-added tax. Now, tax is imposed on sales by government, collected from the customers by a business, paid to customs. Very simple. I buy a product for 10 Rand, including VAT. So now my input tax is done on my purchases. Now I mark up to sell that at 15 Rand, and I'm collecting on behalf of the receiver of revenue that VAT portion. So that VAT portion on my output tax minus my input tax is going to give what I need to pay over at the end of the month or the period to SARS. Just as a reminder from our previous session, is that output VAT is VAT payable on all taxable business activities and supplies, sales, income. Input VAT is paid by the business on purchase and expenses, so your purchase that you make. So maximum turnover in South Africa for not being VAT registered is R1 million over a 12-month period. We currently set at 15%. So again, your duties as an employer is to make sure that you've VAT registered SARS, you're issuing tax invoices to your customers. You obviously do the VAT collection and payment. Some clubs operate on 30 days, so at the end of every month, I need to pay the previous month's VAT bill over. Majority is running on every second month, so 2-month periods. Maintaining proper VAT records, your VAT returns, all the invoices, and again, if you use an accredited software package, it will be self-calculated. And then make sure that you do stay VAT compliant. Great. My last one, and again, I'll finish. I'm going to try and finish in 7 minutes to allow 5 minutes for Q&A, is pricing strategies. Now, again, wear your cap, whether you're a coach, a business owner, a retailer. The first pricing strategy we're looking at is a cost plus pricing. So this is when a business calculates the total cost of producing a product or service and then adds a markup, which is your profit margin, to determine the final price. This ensures that you cover all the costs and generates a final desired profit. It's a straightforward process. You'll start with calculating the cost, so determine what is the total cost of producing the product or rendering a service, your raw materials, your labor, your fixed cost, and so forth. Determine the percentage markup, then calculating the selling price. Now, selling price is your sales price excluding VAT. Then you need to add the 15% VAT. Then finally you get to your retail price. Here's an example. I purchased something for 50 Rand. I'm using a 20% markup percentage. So I take 50 Rand times 20%, gives me 10 Rand. I add my markup to my cost price. I'm sitting with a selling price of 60 Rand. I add my VAT, and finally I'm selling it at 69 Rand to the customer. Next one is value-based pricing, maybe more applicable to our retailers, our custom fitters on this call. Is value-based pricing is focused on the perceived value of a product or service to the customer rather than production costs. Companies use this, or businesses use the strategy, set prices based on how much customers are willing to pay for the benefit that they receive. So how it generally works is point number one, understanding the needs. So if you conduct proper market research to understand what benefits and features are the most valuable to your target audiences. Am I giving lessons with a flying scope, or am I just giving it with the naked eye and tell the person where they need to move the club. Then you need to determine what is the perceived value. Now, perceived value, we've discussed in the previous session, is how much do you think are the customer willing to pay for that service or product? It can involve surveys, focus groups, competitors' pricing, and so forth. Then you set your price based on that value that you've determined. You add VAT, and then finally retail price. Here's an example. I do a custom fitting session at my cost is 200 Rand. It's paying off my piece of equipment. It's paying off my rent or whatever, my labor time. But the perceived value is 500 Rand. All of a sudden, I walk into a studio, I see everything in front of me, happy to pay that as a customer at 500 Rand, or not at 500 Rand yet. I add my VAT. I'm going to do that custom fitting session at 575 Rand for the session. Last one is competitive pricing. Now, this is also quite a desired method. Competitive pricing is when a club or an operator sets its prices based on what competitors are charging for similar products or services. Again, I've used the example of a lesson here, but it could be for the Paradigm driver or whatever is the brand new one, I think it is. If it's done at 13,000, or you're selling it at 11,000, or you're selling it at 15,000, we'll discuss those methods in terms of comparing it to a lesson. Your steps, number one, is do market research. So conduct, firstly, a thorough research to understand the pricing landscape. This includes your analyzing your competitors, understanding the products, the product offering, and identifying what are the market trends. Then determine your positioning. If you 200 kilometers from the next available town or golf club, you can maybe charge if it's a destination course. If it's not, then you will go on the lower pricing scheme perhaps. But decide, how do you want to position your product or your service relatively to your competitors? It can mean that you either lower your price, or you do price matching, or you even go to a premium price, and then finally you set your price. It must be competitive still with the market and allow for that perceived revenue, as we discussed. Here's an example. So let's suppose you're doing a golf lesson at 500 Rand an hour. You can either say, I'm going to go in the lower pricing to accommodate the budget conscious customers in order to gain more customers, or I'm matching to say, well, the competitors are selling at 500 Rand, so I'm going to do it with that to stay competitive, or I'm going to charge a premium because I've got a superior product, I'm rendering better service, I'm using flight scope, our facility is better, our driving range balls are better. The advantages of competitive pricing is firstly your market alignment. Keep your market pricing aligned. Your simplicity, it's easier to implement. People know what the expected cost of a lesson might be. And then also you get customer attraction. Disadvantages is profit margins can either result in very low profit margins or higher profit margins, which is not negative to you, but it could be that you're not going to do as many sales as what you'll do when you just do a matching price. Price wars, seen it many times, especially if you're in the insurance game. Insure my car for 1,000, then you find the next guy gets for 900, and you find this guy back to say, no, I've got it for 900, 850. So price wars can lead up with competitive pricing. And then just differentiation is focusing primarily on what price you can make it harder to differentiate your service or your product to keep on adding value. Great. That finishes my session. I'm so sorry that I took so much time. I hope there's not too many questions, because then I feel I've done a good job. But if there's any clarity that's required, I hope you guys enjoyed this session as well, in the last two sessions, that you guys actually learned something from it. Again, if we struggle in business, go back to basics. That's quite important. So I know we've got 5 minutes, so allow the floor for any questions I might have. Franco, I don't know if you want to come in or say anything, but I'm happy to take any questions or feedback.
Hans, I think while we wait for a question, thanks for the session so far. I think it was an awesome one, also very insightful. And you covered all the stuff pretty much in detail. So yeah, I'm sure there won't be any questions. But if there is, guys and ladies, please feel free to just unmute yourself and ask your question. There's also nothing in the chat box. So
Yes.
you did a good job there.
So I've passed the own exam for those people that didn't mute themselves. Great, guys. Thank you so much. Then you guys are welcome to reach out to me directly if there's any questions. And again, if you battle within your own business, we are professionals. This is what we do for a living as well. So if there's anyone that wants to reach out that needs help with the sections covered in the last two sessions, happy to consult with you. But John, Franco, and PJ, thank you for allowing the webinars this year for me. I'll certainly probably try and be back next year with interesting subjects. Even give me some, or for Adrian, give us some subjects that you guys want and need more. Happy to prepare that for next year.
Awesome. Thank you, Hans, and thanks for your time. Also to all the PGA pros that came to watch, thanks for your time. We truly appreciate it. And yeah, looking forward to the next one, Hans.
Great. Thanks, everyone. Take care.
Thanks, everyone. Enjoy your day.
Thank you, everyone. Take care.
Thanks.